Hi, Renee with EBI Partners, and I have Don Thornton here. He's a senior trust specialist. We're here to talk about a special trust that is going to help you out, especially if you're getting bumped up to the next tax bracket and you don't know how to save money on your taxes. Welcome, Don.
Well, thanks for having me, Renee. I appreciate it.
Tell us about this trust. I know that I've been working with I do a lot of asset protection. Been working with a lot of HVAC companies lately, and we use some online marketing strategies. It's really, the income has bumped them to the next tax bracket. And they were sitting there with their hands up like, what do I do? What do I do? Instead of giving all this money to the IRS, what can I do? So I thought you'd have some answers for these HVAC.
I would. And I would say that conservatively speaking, in the last 6 weeks, I've talked to probably 200 people, a lot of people with different, all different kinds of industries. But the common thread is they're not W-2 employees, and they're all upset and worried about taxes, right? And so, and I can't tell you how many times I've heard people saying, well, what's the point of working hard and making more money if it's just going to bump me up on my tax bracket, and then I don't net as so what I'm not getting a financial reward for doing all that hard work. And so
it's the consequence, right? We use a lot of these online marketing strategies, and it really is bringing in some additional income, and that's it. It's going directly to the IRS. So the solution has been kind of the 1-2 punch that we've been looking for.
Yeah, I mean, I'm a perfect example because I'm a real estate investor. I've been specializing in short sales for 20 years, and I can tell you that most of the time, I'm not bragging, just being honest, being transparent. $500,000 to $800,000 has pretty much been in my wheelhouse for a long time. And very rarely did I ever have a year where I wasn't writing a check to the IRS. And so, I had an S corporation, and for me, because I don't hold anything long term, I don't have investment properties. For me, I'm just flipping. So that means that the money that I make comes in as active ordinary income. So can get expensive. So give an example. If you make below $165,000 in a year if that's ordinary income, you're being taxed at 24%.
24, right?
Yeah. If you go above $165,000, then you're up to 32%.
I was going to say that's 32, right? Yeah.
Which is a big jump, right? So think about it, right? It doesn't seem that much if it's $100,000. Okay, well, you pay a little bit more. You said 24,000, you're paying 32. You get a 200,000 at 32,000 is now up to like over 60, right? And so that is really frightening for a lot of people, because think about that. You're at $100,000 a year. You're paying approximately $24,000 in taxes. Okay, if you work hard and you get out there and you use strategies to bring in more revenue, wonderful. We applaud you. IRS is going to go, okay, you jumped up the tax bracket. So now if you make $200,000, you're going to pay $60-something thousand. So it's a $40,000 jump in your taxes just by being, a great entrepreneur and increasing your revenue. And people think they're being more profitable, but listen, if you're paying taxes, that's expense. That's not profit, right?
And then most people they'll say, well, I can just deduct it. I can just, create some deductions. What is
we're talking about net income here. Okay. So you've already deducted what you can. And here's the challenge that a lot of people have, especially people who do have 1099 income, consultants, direct, sales, commission sales. When they're being paid a 1099, they don't have many expenses. The 1099 people are the ones who are getting really screwed because they have no write-offs. I can't tell you how many times I hear that. I don't have a write-off. What can I write off? I can't write off anything. And so it's like, yeah, you're right. You can't and you won't. So, they feel the force out. Look, I'm a real estate investor. Like I said, I can write off almost anything, and I have. And I tell you, it gets you so far, but you get out of control with that. It's Russian roulette. You be careful because you're going to get audited. And if you can't prove every single thing was legit, then you're in trouble.
So I suppose that's one of the things that was really enjoyable to me about this tax strategy that you've been talking about is the protection, the 100% lawsuit asset protection, but also the protection from being audited. Let's talk about that a little further.
Well, we have a accounting firm that has been servicing trust clients for over 30 years. And I talked to the CPA in the summer, and I asked him, I said, well, how many have you done? He says, well, I lost track after 10,000 returns. Okay. A lot of returns, a lot of clients, a lot of years. And he said, Don, I've never had one of my clients be audited by the IRS. Maybe 20 times in 30 years, they've asked for clarification about a few things. We provided the information, and they said, okay, thank you, and that's it. They've never been audited because this trust, this tax strategy is in perfect compliance with IRS Code 643. So this particular tax code was specifically written into it for trusts. And why is that? Because the ultra wealthy have been using this trust for as long as the United States has been in existence, even before that. So when the tax code was implemented in the 1930s, voila, 643 came into effect. And now, when you use this trust, not other trusts that they can't do this with, this trust with this strategy in compliance with IRS Code 643, everything is completely transparent, legal, no problems.
So say you own a coffee shop or a vitamin shop, something like that, and you are looking for a bit of tax relief. How does this work for somebody like that?
Well, I mean, listen, I don't know if it would be worth it if you're making like below $100,000. I mean, I suppose you can, but it's not, you don't get a lot of bang for your buck. I find that the sweet spot for a lot of people is 180, 200,000 or more.
So once they're bumping up into that 32% tax bracket?
Yes, when you get about, that's when it starts to hurt. Okay. So let me give an example. Okay, so I was talking with a woman who's moving from W-2 into her own consulting business, and she's very excited about it. She says, I know I'm going to make a lot of money. I already have contacts. I already have people that are ready for me to start. And I said, well, how much you're going to make a year? And she goes, I said, I'm being conservative. I believe that I'll make $200,000 in my consulting next year. And I said, that is amazing. But I just want to correct you here. You're not going to make $200,000. She goes, what do you mean? You're going to make about 140, maybe 138 is what you're going to clear. And she goes, what do you mean? I said, you're going to get hit in taxing. I told her 32%. Just do the math, right? $320,000 times 2, that's $64,000, right? So that's 130. She's only going to make, she's only going to clear, $134,000. And she said, oh my gosh, why? And I said, I explained to her, you're a 1099 employee or subcontractor. You have no write-offs, and this is active income, and the entire amount that comes in, your net income is going to be torched at 32%. And so I walked her through how to set the trust up, how to make sure she's the trustee, how she has 100% discretion and power to manage the trust for the sake of the beneficiaries. And I told her that what you want to do is you can set up an LLC to run your business. They don't pay you directly, they pay your LLC. And I said, with this strategy, we can move $194,000 of that $200,000 into the trust, which will be passive income for the trust, and any taxes owed will be deferred in perpetuity. Meanwhile, your LLC is only going to have a net income of $6,000. Now, you're not going to pay any taxes on that, right? LLC it's not going to happen. So, and the $194,000 is now in the trust, the corpus of the trust. You're the trustee, so you manage that. And there's so many more things you can pay for as a trust expense you can't do as a write-off with a S corp or a LLC. So I didn't get, I'm not getting the details right now about how that works. I'm just saying that that shows you how powerful it is. So she goes from projected tax burden of $64,000 to not paying anything.
Powerful.
Right.
This is because of the specific 5 pillars of this trust, correct?
Yeah, it's a non-grantor, irrevocable, complex, discretionary spendthrift trust. Mm-hmm. Now, non-grantor means that you cannot set it up yourself and be trustee, because the IRS will give you 0 tax advantages on that, because they're going to consider it to be an alter ego of yourself. It has to be irrevocable. That means that any assets that are going to be in the trust, personal and business, they have to be sold to the trust irrevocably. So they become the trust property. You can't use the trust as a holding pen where you can pull stuff in and out. That doesn't work. Again, you got to be in compliance with the IRS rules. So discretion, discretionary part of it means that as trustee, like I mentioned before, you have full authority and responsibility to manage the assets on behalf of your beneficiaries. But basically, you control everything. But there's one more part of the discretionary pillar that is very important. When the money, the passive income is coming in from your LLC, that passive income can be declared an extraordinary dividend by the trustee. So you have the discretion to declare that income to be an extraordinary dividend. And because of IRS Code 643, subpart A, B, C, and D, then that's not considered a taxable event. It's not a taxable event as long as the money stays in the corpus of the trust. Now, if you disperse it, you're going to pay money. You're going to pay taxes on whatever you disperse. That's why you want to keep it in the trust, and that way that money is not going to get taxed. The whole idea of this strategy, using the trust, using this strategy, is to limit or eliminate any taxable events.
Right. Correct.
So let me ask you a question, Renee. What are you taxed on? What does the IRS tax you on?
Well, just about everything. In my world, I'm still.
Well, I'm not talking about you specifically, just in general. It's a very common misperception here. People think that you're taxed on your income. You are not. You're taxed on taxable events.
Oh.
Okay.
I understand.
So this strategy has no taxable events. None. And it's perfectly legal because it's in accordance with the IRS's own.
People often ask me when I'm walking through this tax strategy, well, then how do I run my business? How do I get paid? How do I pay my bills? And I like your answer to this.
Yeah, I mean, it's very simple. The trust can pay for anything. If your trust assets, if your business assets are sold into the trust and you are running your business through an LLC and you're leasing the business assets into the LLC from the trust, and you're making the trust a 90% limited partner or a member in your LLC, okay, then the trust is obligated to pay for any expenses that have to do with your assets. Okay, so let's say if you have, if you're an HVAC company, right, then your trucks, your equipment, your machinery, your tools, every single thing that is going to be sold in there to the trust, and that's going to be a trust asset. So that means that anything having to do with your business at all, it is a trust expense. So I'll give you an example. If you HVAC company, you have a van, you go out to places, you can't deduct gas. You can deduct some mileage, but you cannot deduct gas. If you go to Jiffy Lube and you get your oil changed and you get your tires rotated, that is not a write-offable. You can't write that off expense. Okay, it is with the trust. So everything having to do with that is it's a trust expense. Now, even that applies to personal expenses as well. So if you sell your primary residence to the trust, same thing. Your mortgage, your insurance. If the water heater breaks, you got to call a plumber. Trust pays for it. Everything there. You want to put a new roof on? Trust pays for it.
I get a lot of questions on this, so I'm glad you walked through that because people are concerned, and they also are concerned if they have a vehicle or a home that has been sold to the trust, how can they sell it?
The trust sells it. It's just like you sell it normally. The only difference is that you sign the title, you're going to sign it as trustee of the trust when you sell the vehicle.
And let's talk about the capital gains associated. I mean, if you have
okay,
a real estate investor like we are, and you're buying a lot of properties.
Okay, well, I find that capital gains generally falls under three headings. You have investment properties in real estate side, when business owners sell their businesses, or crypto. Right? Crypto. Those are really the three biggest ones that I talk to. All right. So investment property. It's not your primary residence. It's a buy and hold situation. You're renting it out, and you decide at some point that you want to sell it. So when you do that, when you at the sale, then you are obligated to pay capital gains taxes. Now, the most famous strategy to avoid paying capital gains when you sell an investment property is you're going to buy another property and put that money there, and you have a 90-day window to decide what property that is, and you have 6 months to close.
And try to do that in a market like we were just experiencing. Yeah, good luck, right?
That's easier said than done. Mm-hmm. So, but that's the only strategy that most people know about. Well, with this trust, if it's a trust property and the trust sells it, signs a contract, it closes, the money comes in, that is not a taxable event. Those capital gains taxes will not be paid because they're inside the trust. As long as you keep them inside the corpus of the trust, you don't disperse. Okay. Now, business owners, same thing. You're going to get hit with capital gains. Now,
if you're selling your business, meaning
you're selling your business, yeah. So I have a client that came to me because he was selling his business for like $7 million. I think he was on a hook for like $1.7 million for capital gains. And we talked about this, and of course, it's people with that kind of money. They're going to be very careful about doing their due diligence and so forth. But it took us about a month. But then, bottom line was he didn't pay anything, no capital gains. So imagine what you could do as a business owner when you have, instead of cutting that check for $1.7 million to the IRS, that's in your trust account. You can do whatever you want with it, provided that it's a trust expense. And you can, buy another business. That's the market. You can do that. And that's the beauty of it. So, and it's so capital gains there as well. Crypto, same thing. I mean, you're getting caught with capital gains on crypto when you sell it. So you do the same thing. You put the crypto into your wallet, and your wallet is then put into the trust as an asset, and then whatever happens, you're never going to pay capital gains on that. It's going to be permanently deferred. And by the way, I forgot to do this at the beginning. I just want to put a disclaimer out there. Okay.
Yeah.
This is all for informational purposes only. I am not a licensed tax advisor. I'm not a licensed attorney. I don't claim to be. Like I said, this is for informational purposes only. And I urge you, before doing any financial transactions, to consult with a licensed tax authority. Okay. So having said that, I do know about trust, and I do know a lot of this stuff. So, take this information in, and of course, do your due diligence, and including, with licensed professionals to make sure that you're okay before you make any decisions. But I can tell you just from my own experience about what my clients have had great success with. I have a client that she's in Chicago, and she has a W-2 job, but she also has a side business that makes about $800,000 a year, cosmetics.
How does that work with both the W-2 and the 1099?
Yeah, I don't know why she bothers with W-2. I guess she likes it, but she certainly made enough money to be on her own. And we can't help her with the W-2.
No.
But we can help her with the business. So that's what we did. We worked it out to where she, she bought the trust, and then she sold the business assets to her personally, and then she sold them to the trust. And now, when you do this strategy, the trust is not giving you money. The trust is going to give you what they call a demand note, or it's like a promissory note without interest. So let's say, for example, that I'm going to sell my primary residence to the trust, so it becomes a trust asset. And let's say that it's $500,000. Okay, so then the trust will give me a demand note for $500,000, which I can draw against whenever I need something that the trust cannot provide. So we call it the 3 Fs: food, fashion, and fun.
Right.
So if I want to go down to, let's go to the grocery store and buy a month's worth of groceries or whatever, I can't charge it to the trust. But what I can do is say, okay, I'm going to budget $1,000 a month for food, let's say. Okay. So they'll say, okay, well, I want to do something else. Let's say I maybe need to buy the kids' school clothes. Maybe I need to buy myself a suit or whatever. So I figure out what I'm going to do. And let's say, okay, I'm going to pull out $8,000. Okay. So what happens then is that I would draw $8,000 from that $500,000 note. which is going to reduce it down to $492,000. So it just reduces it down. And the $8,000 that I take out is not a taxable event. So that's how I get my cash. So that's how you do that. So anyway, when getting back to the house, so once that's in there, then the trust pays for everything having to do with that asset. And then when, now you wouldn't get capital gains for a primary residence, but if it was an investment property,
Right.
you would. And because it's a trust property, then you're not going to pay capital gains because it's going to stay in the corpus of the trust. And according to IRS Code 643, there's no capital gains event, tax event. So that's the beauty of this system. It's so, I mean, it's funny that I often get two types of reactions. It's too good to be true, and it can't be that simple.
Mm-hmm. I get it too, and I even advising a lot of those that have that are on the W-2 classification, just advising them to talk to their human resources department to see if they can make a switch to 1099 status. Yeah, so that they can reap the benefits.
You can. Mm-hmm. So it just depends on what you want to do. So the strategy itself is pretty much flawless. And at this point in time, I don't know why anybody would want to do other stuff. I mean, I hear, if you go on the asset protection side, you hear a lot about people that will set up a trust, an LLC in Wyoming, and they'll have like a whole labyrinth of LLCs, right, to try to protect stuff. And listen, you're paying through the nose to those financial advisors and those attorneys that are setting this stuff up. And it's all designed to make sure they can't get sued, or someone sues them, they have to go through so much trouble to get to them that it would be not worth their while. But any attorney that is determined can crack that labyrinth of LLCs. So I would call it illusory protection, because of the spendthrift provision in this trust. It's practically impenetrable. The only way that the government or the attorneys or people who want to sue for whatever reason, only way they can crack it is if they can show that there was fraud being done by the trust or criminal activity. But normal business, law-abiding citizen, following all the rules and so forth, if somebody decides, there's so many people out there that I read about this woman she's an attorney in San Francisco. She was suing everybody. She was filing like 10, 15 lawsuits a month because she was banking on people settling just to make it go away. Okay. So you get a lot of people. I mean, I was talking to a restaurant owner this summer, and I said, from a legal point of view, what is your biggest concern? She said, slip and falls. I mean, you can drive down. I'm sorry I didn't go back and take a picture, but I was driving down a road recently and I saw the big billboard, slip and fall. And that's a big industry, right? With this trust, with the spendthrift provision, it cannot be sued. Now, anybody can file a lawsuit. I'm not saying you can't file a lawsuit, right. But when the judge is informed that the property is an asset of a spendthrift trust with a spendthrift provision, they'll toss it because it can't be sued, right? And so, I had a situation like that. I'm not going to go into big detail on it, but there was a situation where there was a discrepancy on price, and the buyer wanted to sue and say no. It was a situation where we thought it was going to be an equity deal, and then it turned to be a short sale because the payoff came in $30,000 more than what anybody expected. And he said, no, that's my price, and I'm not doing a short sale, and you owe it to me. And it's like, well, it got pretty serious, and and I said, it's fine, go ahead, but just to let you know, full transparency. This isn't a spendthrift trust, and they walked away. I never heard from them again. So,
right, and if it was brought to court, what happens?
The judge would toss it.
And why is that?
Because it has a spendthrift provision, and because of the spendthrift provision with this trust, which is based on contract law, not legislative law.
Contract law.
It can't be sued.
Mm-hmm.
I mean, the asset protection is so strong that it can stop an eminent domain lawsuit in its tracks.
Yes, I would really like to cover that. I've been talking about this fact with a lot of real estate investors, and they don't believe that this could be true. They're still having a hard time wrapping their head around the capital gains being deferred into perpetuity, and this just blew their mind. Let's talk about it.
Well, out west especially, you see a lot of this eminent domain stuff, but it happens here in Florida too. I had back in 2005, I believe, I was talking with a realtor that was involved in my short sale business, and I think they had 3 Beef O'Brady franchises, and she said they were in a big lawsuit with the county because the county was going to put a road in, and they told her that she had to sell, and the offer was not market value, and she had settled because they couldn't do it because she said like eminent domain is like a bulldozer. You can sue, but they're going to get you. Well, the trust, if they had sold those assets into the trust, okay, and if it was the building, the land, everything in there, and so forth, and they could have told county, federal, whatever government entity is trying to do eminent domain, they would have to go around it. Literally, they'd have to go around it, or you could use that as leverage to get the price that you want. So I mean, it's like the I don't know if you ever saw you ever heard of Dido, that British chick, the singer?
A band, yeah. Mm-hmm. What?
Yeah. Anyway, she did a song where her video was she was in a metropolitan area with skyscrapers everywhere, and she had a small house that everybody built around, right? And so I think about that all the time in this scenario because literally that's what you can do. I mean, you can be an oasis, in a desert of growth, right? Industrial growth, progress, whatever you want to call it, road building. They cannot move you unless you want to be moved. And so what I tell people is, if you have an LLC, can you stop eminent domain? No, this trust can. So if it's that powerful with eminent domain, imagine how powerful it can be against a slip and fall lawsuit or a predatory lawsuit.
It's true. We've got a couple minutes left, and I just want to wrap things up. Is there any other industry or any other? What are some frequently asked questions that you get? I covered all the ones, the slip and fall, asset protection, eminent domain, and capital gains, deferred into perpetuity. What else is the most enticing aspect of this 5-pillar spendthrift trust?
I would say it's 50-50. The asset protection, that's the foundation, because you have to build your business and your income, your revenue, on a solid foundation that can't be taken away from you unless you mess up yourself.
Right.
And then the other thing is that once that foundation is built, then you can use the amazing tax reduction strategies that are perfectly legal, like I said. And I keep repeating IRS code 643. This trust especially is set up for this tax code in perfect compliance. And I would say, don't let your preconceived notions prevent you from thinking or accepting the fact that this does work. And I'd like to leave you with one quote. Warren Buffett famously said, "My secretary pays more taxes than I do."
I show that video all the time. It's one of my favorite quotes. It is.
Why do you think it is? Because the rich have rigged the system since the beginning of the tax code, and this is how they rig it. Well, now it's available to you if you are open enough to explore it and see if it works for you. So I would say $200,000, you're above $165,000 and you're getting ordinary income, whether you're a business owner or you're a salesperson or 1099, then you're foolish not to do this.
Realtors, anybody in the Salesforce world, it's definitely worth exploring. Down at the bottom, assetprotection.now.site, ASSET protection at now.site. This is where you're going to get some additional information. There's tons of webinars that we have put together for you guys. If you have specific questions, we want you to give us a call. The phone number is there. The website is completely open. You don't have to put any information in there. You can just watch every single one of these webinars to learn a little bit more, see how it specifically is tailored to your business, and then give us a call. We want to help you lower your tax obligation.
Well, so thank you for coming. I appreciate it.
You answered a lot of questions. I keep getting more and more questions the more we discuss this. So I'm really glad that we were able to connect today. So
thanks for having me.